Do you want to raise your credit score fast? Well, you're not alone. Credit score, that three-digit number, holds a lot of power. It's a key factor that lenders use to determine your creditworthiness. It's like your financial report card, and just like in school, you want those scores to be high. But why is it so important? Well, your credit score affects many aspects of your life. It influences the interest rates you'll get on loans, the insurance premiums you'll pay, and sometimes even your employment opportunities. If you have a high credit score, you'll likely qualify for lower interest rates on loans, pay less for insurance, and have a better chance of getting that dream job. But on the flip side, a low credit score can make it harder to get credit, increase the cost of borrowing, and limit your opportunities. It's a crucial part of your financial health, and understanding it is the first step to improving it. So, you see why it's crucial to have a good credit score. But how can you improve it quickly? Let's dive in. The first step to raising your credit score is understanding your credit report. So what exactly is a credit report? It's a detailed record of your credit history compiled by credit bureaus, and it plays a crucial role in determining your credit score. It's like a report card for your financial life, and just like in school, you want to aim for high marks. Now you might be wondering, how can I get my credit report? Well, you're entitled to a free credit report from each of the three major credit bureaus, Experian, Equifax, and TransUnion, once every 12 months. You can request these reports through the official site, annualcreditreport.com. It's as simple as clicking a few buttons. Once you've got your report, it's time to dive into the details. There are several key elements you'll want to look out for. First, personal information. This includes your name, address, and social security number. Any inaccuracies here could be a sign of identity theft, so make sure everything is correct. Next up, credit accounts. This section lists all your credit accounts, including loans and credit cards, along with the amount you owe, your payment history, and the status of each account. Then there are inquiries. These are records of anyone who has requested your credit report. A large number of inquiries might indicate that you're taking on too much debt. Lastly, public records and collections. This includes bankruptcies, foreclosures, lawsuits, wage garnishments, and any accounts that have been sent to collections. These are serious red flags that can significantly impact your credit score. So why is reviewing your credit report so important? Because errors can and do happen, and these errors can lead to lower credit scores. If you spot any inaccuracies, you have the right to dispute them and have them corrected or removed. Remember, knowledge is power. Once you understand your credit report, you are ready to take steps to improve your credit score. A key factor in your credit score is your payment history. This is where paying your bills on time really comes into play. It's crucial to understand that even a single late payment can negatively impact your credit score. So, it's all about consistency. Now, you might be wondering, how can I ensure I'm always on top of my bills? Well, one effective method is setting up automatic payments. This allows your bank to automatically pay your bills when they're due, preventing any chances of missing the due date. It's like having a personal assistant that never forgets. However, be mindful of your account balance. Automatic payments can lead to overdrafts if your account isn't adequately funded. Therefore, it's important to keep a close eye on your finances. Also, remember that not all types of bills are reported to credit bureaus. Generally, it's your credit card payments, loans, and sometimes utilities. So, prioritizing these payments can be a good strategy. Remember, consistently paying your bills on time can significantly boost your credit score. So let's make it a habit, shall we? Next, let's talk about credit utilization. This refers to the percentage of your total available credit that you're using at any given time. It's essentially the ratio between your credit card balance and your credit limit. So how does it affect your credit score? Well, credit utilization is a significant factor in the calculation of your credit score. It makes up about 30% of your total score. High credit utilization can signal to lenders that you're overly reliant on credit, which can negatively impact your score. Let's say you have a credit card with a limit of $2,000 and your balance is $1,000. Your credit utilization ratio is 50%, which is higher than the recommended level. Most experts suggest keeping your credit utilization below 30% to maintain a healthy credit score. Now, how can you go about reducing your credit utilization? First, pay down your balances. If you can, make multiple payments throughout the month to keep your balance low. Second, consider increasing your credit limit. Sometimes, a simple phone call to your credit card issuer requesting a credit limit increase can help reduce your credit utilization ratio. However, only do this if you're confident you can manage the additional credit responsibly. Another strategy is to spread your charges across multiple cards to keep the utilization lower on each card. But remember, the goal is to manage credit responsibly, not to create more debt. Lastly, consider using a secured credit card. These cards require a security deposit and can help you build credit over time. This strategy can be particularly useful for people new to credit or looking to rebuild their credit score. Remember, the key is to show lenders that you can responsibly manage your credit. Reducing your credit utilization is not a quick fix, but a long-term strategy. It requires discipline, but the payoff is a higher credit score, which can lead to better loan rates and more financial opportunities. Reducing your credit utilization is a powerful way to raise your credit score. Now, let's discuss a tool that can help you build credit: secured credit cards. Secured credit cards are a type of credit card designed for individuals who are new to credit or looking to rebuild their credit score. Unlike traditional credit cards, secured cards require a security deposit that acts as your credit limit. This means that if you deposit $200, you'll have a credit limit of $200. These cards are a safe way to build or rebuild credit because they limit your spending to the amount you've deposited. This helps prevent you from spending more than you can afford to pay back, which can lead to debt and harm your credit score. Now, let's take a look at some specific secured credit cards that can help you on your credit building journey. The Capital One Platinum Secured Credit Card, for example, is a great option. It has a lower minimum security deposit compared to similar cards and offers the potential for a credit line increase in as little as 6 months. While it does carry a high variable annual percentage rate, responsible use can lead to an upgrade to an unsecured card and a refund of the security deposit. Another card to consider is the Capital One Quicksilver Secured Cash Rewards Credit Card. This card offers 1.5% cash back on all purchases and 5% cash back on hotels and rental cars booked through Capital One Travel. Just like the Platinum card, responsible use can lead to a higher credit limit and eventually transition to an unsecured card. Remember, the key to using secured credit cards to build credit is to make your payments on time and avoid maxing out your credit limit. And don't forget, these cards report to the major credit bureaus, helping you improve your credit score over time. Secured credit cards can be a stepping stone to improving your credit score. Let's quickly recap what we've learned about raising your credit score fast. First, we dove into understanding your credit report. Remember, your credit score is a summary of your credit history. It reflects your financial behavior over time, and lenders use it to assess your creditworthiness. To stay on top of it, you must regularly check your credit report for any discrepancies or outdated information and promptly rectify them. Next, we spoke about the importance of paying bills on time. This is a significant factor in your credit score calculation. To ensure you never miss a payment, set up automatic payments or reminders. Not only does this help to improve your credit score, but it also prevents late fees and maintains a positive relationship with your creditors. The third point we discussed was reducing credit utilization. This is the ratio of your credit card balances to your credit limits. A lower ratio is better for your credit score. So try to pay off your balances in full each month, or at least keep them below 30% of your credit limits. Finally, we explored building credit with secured credit cards. These are excellent tools for individuals new to credit or looking to rebuild their credit score. The Capital One Platinum Secured Credit Card and the Capital One Quicksilver Secured Cash Rewards Credit Card are two noteworthy options. They require a security deposit, which can often be lower than similar cards, and offer the potential for a credit line increase in as little as 6 months. By following these steps, you can raise your credit score quickly and effectively. Thank you for watching.